Nvidia is the talk of the town for investors and traders like you and I right now. And why not? It's probably going to become the largest company in the world very, very soon. And with the gamma squeeze occurring right now that we'll talk about in today's video, nothing can go wrong. Or can it? Today we have a look at history of when we start to get this bubblicious style market and what it means for us as investors and traders. More importantly than that though, we're focusing on the smaller timeframes as well. The dark pool liquidity that started to appear, the negative gamma that happened over the last 24 hours, and the most traded zone at these peaks. Are we about to see a couple of percentage points off the market before we resume the bull trends? And then there comes GameStop. Yes, it broke one of the key levels we've spoken about recently. So in today's video, we need to look at that, along with opportunities that might be on the horizon for some of the small cap stocks. Join us as we cover stocks, commodities, and cryptos around the world. There's a lot to discuss. Let's get into it. So welcome back everyone to The Daily Show. My name's Tom, and as we always do, let's go through the latest macro data, lead indicators, and figure out how this helps us as investors and traders. It's pretty clear that at the moment, we've basically just got semiconductors ruling the market, and actually, if you took them out of the market over the last 24 hours, we would have been down a lot more. But let's begin our first story today to look at some opportunities on the horizon. Then we'll go through whether this mega cap kind of situation is healthy for the market, or it spells disaster only a little while away. All right, so let's go through the Russell 2000 to get started. And of course, this is one of the big things at the moment. Russell 2K versus SPY. We are back to levels that we haven't seen since late last year, and before that, realistically, 2001. So are small caps undervalued? Well, by most metrics around the world, they are. And this is actually a worldwide phenomenon we're seeing right now. Large caps, companies with great balance sheets, they're going up. Why? Higher interest rates. But one thing that we haven't really started to talk about yet is M2 flow. And let's get into that in just a quick moment. But basically, small caps are cheap across the board. And what we know about small caps is when the Fed prints, when central banks around the world print, they tend to do very, very nicely. Now, is that starting to change? Are we seeing liquidity starting to come back into the market? More importantly, the Federal Reserve being accommodative of these smaller caps. Well, as they underperform, as it turns out, we're starting to see US M2 money supply actually increase. And remember, this has been decreasing now since the highs of 2021, which realistically was their point of easy money. We saw things like IWM and stocks such as ARK stocks, Cathie Wood stocks, going absolutely wild. Remember, just that kind of couple of years ago, it was companies that made no money that were the hottest thing. Now everyone wants companies that do make money, and how time has changed. So why is this important? If we start to see this accelerate, it's probably going to bring in smaller cap stocks and make them do better. And this is one of the most important factors, I think, underneath the hood, because as we know, if realistically M2 supply starts to come back through, it could mean that we're going to see Russell 2000 and mid caps outperform some of the bigger caps for a while. So is this a time to be scared of markets? Well, there are some signs saying that maybe we're in a little bit of limbo land. And as we go through the options later on today's video, it might make more sense to you. But here's a great one from Daily Chartbook and Sentiment Trader. And basically it's showing us here that S&P 500 is registering the highest high in a year, so obviously making a new high. But we're starting to see a little bit of weirdness in terms of the advanced decline line. Now, we first brought this up last week, showing that actually a lot of stocks were declining while the market was barely grinding higher. And when we get these reads, which we have quite a lot of, generally speaking, first thing, we are still in a bullish trend. So I think that's very important to state. And secondly, we tend to go into a bit of chop and a little bit of a decline. So the next kind of week and a half, 2 week period is actually a 50% system. Now, if you know anything about your market stats, that actually is gearing towards the negative side because markets are generally bullish across the board. So what are some of the reasons why we might decline? One of them, probably inflation concerns, which continue to be there. And as you can see here, there are a few reads coming out. This one from Mike Zaccardi and obviously Bank of America. And it's basically showing that a lot of people are concerned about a rising interest rate. The US 10-year and the US 2-year are expected to possibly rise back up to 5.1 to 5.2. And there's a lot of technicals being driven in here. Now, I'm not huge on looking at the technicals too much on yields. Obviously, I do believe yields will stay relatively high. But what I'm looking at is not so much the yield. I'm looking at M2 supply and also whether central banks are being accommodative to data. As you can see here in the macro charts overall core risk portfolio or core risk model, you can see we're starting to enter back into that kind of, let's be a little bit concerned about a small pullback, not necessarily about a crash, but certainly about a small pullback. So I would say put the caution blinkers on here, and that's why we've been looking so closely at the charts themselves. Does that make sense to S&P election years? Well, it kind of does. I mean, we basically do a little bit of choppy here for June, and then we usually go June, July, August, very strong months if we're following similar patterns to the previous history. And usually if we're going to see further weakness, it happens somewhere around September, October. Remember, this year is election year. It's going to be hotly contested, and there's a lot of kind of risk at the back end because, of course, in uncertainty, markets tend to freak out. So I'm pretty sure we'll get a secondary sell coming in later on this year. So with all of that considered, let's talk about the big elephant in the room. Nvidia is expanding at a very fast rate, and it is probably going to become the world's #1 largest stock. If I was a betting person on this, I would probably say it is going to become it. And there are a couple of reasons. Number one, stock splits usually expand a stock fairly heavily. Obviously, Nvidia has announced that. And we looked at that about 4 or 5 videos ago, so definitely check it out. Some great stats there showing that usually we perform 1.5 to 2x over the S&P during those stock split times. Whether that's real or not, it's just what the stats end up doing. But there's a good chance that infrastructure play will come up. Now, why is this? Because when we look at history, it turns out that actually this is a very interesting time. Now, this is actually the top 5 stock concentration. And of course, we're basically at the highest point that we've ever been. And this one here is from Dave Nadick over on X. But what we're really seeing here is extreme concentration, but an extreme trade. So this is a great chart here from Todd Sohn. And basically what it shows, as far as I'm concerned, is that semiconductors are, of course, the play. We know that. Semiconductors have accelerated at an extreme pace in recent times. But notice back when we have a look at the tech boom, we had a hardware boom, Cisco and Intel. Now, in my opinion, it's kind of the same right now. Nvidia is a hardware boom. In many ways, it's an infrastructure build. So because we're doing an infrastructure play here, this could get very concentrated. And it's very clear to me that this is where the bubble will be. It already is coming. Of course, it will detach from all reality and will probably end in some kind of similar way to this, where Nvidia will, of course, not die, but it will come back to some kind of forward earnings level. Now, you might say, well, this is different, everything else, but it's kind of likely that we're getting very concentrated. Now, what would history tell you about extreme concentration? It would tell you to be cautious with leverage. So basically follow the trend. We don't want to go against that because the trend can get extreme. I'm going to expect an extremes trend. And what that means is some wild numbers. And people have been throwing around, I'm loving this one, $10 trillion sized company for Nvidia over the next 12 months. What do you think? I'm going to put a poll out later to see what you guys think. People think it's 10 trillion. I wouldn't be surprised at all for number one, maybe 5 trillion, very possible. And of course, an extreme trend incoming for Nvidia over these periods. And we're going to get some wild swings as well. So expect some wild swings as we drive through. So how high will it go? Well, history will tell us. But in general, you could experience some extreme moves. And I would say that it could get very, very wild. Now, why is this important to stack up? Because we are starting to get technical warnings, and they are continuing to stack specifically in the NASDAQ. Now, as it turns out, when we got these technical warnings, we've really seen them a few times. We've seen them specifically around the GFC, around the tech boom, and around the kind of early 90s crash period that we saw over there. Now, this one here wasn't so bad because, of course, we ended up driving in very, very heavily after that little bit of a crash into a very strong market. But I think this time we need to be paying attention to it. So it's something we'll look at. And if that gets back into the 60s, then, of course, you could be concerned. Are we there yet? No. Now? No. So would I be concerned at this stage? I don't think we need to be. I think that in general, you're running the trend, but you want to be aware of these things. Why do we not need to be concerned? Well, in general, if you look at most bull market behavior checklists, this is just an example of one, but there are many different versions out there. In most of them, you're looking at around 80-90% saying that we're in a bull market, and usually when you're in a bull market, they continue to go. We've already discussed why higher interest rates for longer could mean commodity prices continue to be a really good area, emerging markets continue to be a really good area, but in general, we believe we are in a cyclical bull market that is going to have a median duration of at least 32, 31 months, and that we are not actually there yet. Remember, we are still many, many months away from that. So still a bit of time to go before we even reach the median duration of a new cyclical bull market. And I think it's fair to state that this is probably the position and the place that we find ourselves in. So let's talk about the right now, right here, because we are seeing unusual activity. And there's no doubt that there's a little bit of the bear starting to come and show their face. And specifically, we got another read here on the ProShares Ultra S&P over the last 24 hours from volume leaders. And basically what this is showing us is that we have a dark pool activity at the exact same level we've had all of the other trades so far. And when we've seen similar things than this, we've generally had little-ish pullbacks afterwards. So is it primed? Yeah, technically it is. It's around that level where you would expect maybe a negative gamma situation to show up. And this one here from Gamma Lab, which I shared over on our X, kind of shows you that we're starting to creep back into the negative gamma situation. Now, if we do go negative gamma, that may push markets down. And I don't think it's going to be very deep, but it is something that we are paying attention to. So let's jump into the charts before we look at the options and have a look at S&P to begin with. So S&P 500, last 24 hours, positive delta, little bit of purchasing underneath the hood. Obviously, we had dark pool activity right on this level here, which sits around 53.10. And as we expected to see a little bit of selling come in here. Now, we did get it, and we'll use the futures to kind of show you here. We got it right on our zone. And in fact, if you look at our weekend video, this is exactly what we suspected. A little bit of a high, hit into our red box here, comes back down. In this case, it rallies for a second entry. Look how it comes to the most traded zone, and then it finds a little bit of a sell. Now, it's not to do a victory lap on it. Who cares? It's like 0.3%, yeah? But in general, this is the type of pattern that you usually see. And to go against trend, you're going to need a lot because you don't want to go against trend. That is a bad idea. This is the worst I've seen the market in this entire V so far. So what that means is it's the most likely, but nothing is guaranteed. If I had to rate it, I'd rate it like a 6 out of 10. If it was in the direction of trend, I'd rate it like an 8 out of 10 because it would be so much stronger in the direction of trend. But the most traded level, exactly where we expect those dark pool liquidity kind of positions to come in, has been happening. We obviously now could be opening with a gap, which is something that we kind of don't mind to see because, again, that probably means that whatever's coming down will probably be met with a bull demand. And if we start to move through levels such as 52.75, we basically move into a negative gamma situation. So this is where, well, it's actually just under 5,300, so where we are right now. But under here specifically, it should accelerate. Now, where could this market go? Well, the general first level is somewhere between 51.85 and 5,200. And that is around, from the top, probably around 3 to 4%. Remember, if it wasn't for Nvidia, we'd probably already be going down there. So yeah, about 3-ish% down that point. So is it a massive sell-off? No. But of course, we're in a cyclical bull market right now. So this is what a trader is certainly going to be looking at. And I think it's a good one to study if you've been watching the show. And we'll see how it ends up playing out. Very interesting level. Let's have a look here at the options walls, and you can see that they are coming fast and furious. Basically, there's a huge amount of positive gamma situation after 53.25, and 52.75 is a huge put strike. So expect someone to try to buy that level. Now, if we move through that zone, 5,200 becomes the next target from an options perspective. And you'll notice there's actually a little bit here sitting on the 29th at 51.85. So interesting to see the puts sitting right on that exact perfect zone there. The next day, if we look at the 30th, again, if we were staying hot, then we would be going above 5,300, 5,310, that kind of level. Then we could be entering into an extreme positive gamma situation similar to Nvidia. But again, we're not there at this stage. So I think it's a very interesting time in the markets. And it's probably, again, the first period that we've seen real weakness since that V showed itself on the weekly 20 moving average. What about CTAs, though, commodity trade advisors? Are they agreeing with potentially a little bit of weakness? Well, they have bought up in recent days, but they're still neutral. So this is a neutral chart stuck within a range. Not unusual to see the CTAs do this kind of thing. And S&P is something similar. So still in a bit of a downtrend here, with CTAs not buying the dip as much as they did in previous times because they're going to neutralize their position. They always do this. From the world of other markets, though, Brent has been very sneaky. Look at this. CTA is actually injecting. And if you notice, this is a little delayed, of course, by a day. We actually find ourselves here now, which could suggest this is a Wyckoff base. And yeah, it's been very, very sneaky. Of course, I've been playing with this one. I found what I would consider a good bull level. We ended up having to go neutral on that. And then we saw it come back up. And we'll go through the charts a little bit later on because this is an interesting one for sure. Gold, on the other hand, still dropping like a rock from the CTA side. We'll get an update on this soon. I am very, very bullish on gold, but yeah, to see it neutralize is totally fine. So let's now take a look at the options, and we'll begin here with Tesla. And obviously Tesla has been holding above the 175 and kind of selling off that 180, 185 level. It's still stuck within the range and there's just been no breakout for it. So Tesla's still struggling in the options, and you can see here that's pretty stacked on puts moving forward. So I'd like to see a base being formed, but if it starts to go into the negative gamma situation, it could get ugly very fast. So Tesla holding barely onto life. Nvidia, on the other hand, looks totally different. It's positive gamma all day. We move through 1100. If it holds above 1100, 1150, 1200, this thing can absolutely run. Huge amounts of options opens, lots and lots of activity on the call strike, especially near date ones, driven mostly by retail traders and a bunch of hedge fund managers trying to make quick money. And it's on a roll. So for now, I certainly wouldn't be going against it. It's a massive positive gamma situation, and I would not fight that trend. Eventually, it will show itself, but at the moment, it is bull all day. GameStop, this is another one. Positive gamma situation. We're back in positive gamma. 25 strike, you'll notice for the 31st in particular, is a huge level. So if the market can hold up, which it's now back above that previous zone, kind of shows you that maybe GameStop is back on the run. And I think this is a very important point because, of course, if you're going to trade GameStop, then you're going to need a broker that has 24-hour access. And of course, yes, we are sponsored today by Tiger Brokers. And luckily, if you are in Australia or many other countries that Tiger Brokers does offer down below, you might be able to get access to their 24/5 markets. So another thing that you've got to love about Tiger Brokers is they constantly upgrade their software. And I'm about to show you one of their new features, which is to be able to go in depth with a stock. Now, if you know, one of my 3 pillar stocks at the moment is Google. And of course, being able to see all of the buy ratings, being able to see the themes at the moment in terms of what people are searching, what the company actually does, filings, discussions, all of these types of things is very powerful. Also, a lot of people right now, whether you're trading GameStop or anything else, you want to see the option streams, and you'll also want to see whether the short interest is very large. Now, of course, for something like Google, it's not going to be. But what I like to do is I like to look at the PE and specifically select 5 years. And what this tells us and it shows us is whether it's cheap historically. Now, as you might be aware, we did a special on Google a little while ago and it was damn cheap. In fact, it was one of the better ratios that we've seen in some time. And with upgrades coming in from, of course, some of the bigger players on town, it made it so that it looked like it would be a good point for us to look at the stock. And the stock's been performing very well. So if you want to find out more about your favorite stock, more about the financials, the analysis, the profiles, the options, it's all there within the Tiger Brokers platform. Another thing I like about Tiger Brokers is that they've just introduced a new AI software. Basically what this is Tiger GPT. Effectively, you can ask it questions about your favorite stock and it will tell you things. In this selection, I've basically said, is there any large news stories coming out? And, there is one here that I wanted to pay some attention to. This looks like a good one. Google signing a cloud deal with Hitachi. Maybe I want to know something about it. You know where it gets better? You don't have to read those articles anymore. Summary, bang, here it is. Opportunities, risks, everything else, it's there in the platform. So if you want to be part of course, the Tiger Revolution, I guess you would say, in terms of being able to access some of these great technologies and new things that are coming out. Again, check out the links in the description down below. Thanks so much, Tiger, for sponsoring this video. All right, guys, well, let's jump into the charts and we take a look at everything that's going on right now. And we'll start off here with the VIX. So I think it's pretty clear that the VIX has started to show some activity. We talked about watching a reaction under 12. We got it. And it looks like this volatility is coming through. Now, we also saw that things like Goldman Sachs were showing stretched indicators, but it looks like the bonds market options are starting to wake up a little bit as well. This is one of the things that you want to be looking at. We do cover it here daily, and we're seeing yields also on the rise. So a couple of concerns out there right now about inflation still being sticky across the board. again, look through that. Really what this is it's a blip. It's a reason for the markets to sell off if they're overextended, if it is profitable for them to do so. And you can see here that the S&P 500, a few of you have been asking, where's our central bank liquidity indicator, is still seeing liquidity on the increase. In fact, after that drop, which is generally a seasonal drop that happened here, we're getting a decent resurgence back in the liquidity indicators. And M2 flow is, of course, on the rise once again as well. All of these things will end up being supportive of the economy and of the cycle. So that is important to state. Now, where are the weaknesses? Well, the big weakness here has to be home construction. It looks terrible on a chart. That's not one that I'd be buying right now. You've got this big rejection wick. It looks like it's kind of like a head and shoulders in many ways in terms of an angled one, and it might be about to start falling off. Now, that doesn't mean that the markets are all going to collapse, but what it does mean is you need to start paying attention to, again, leverage in systems and everything like this. And I'm here to tell you right now that I'm not seeing extreme leverage in the markets at this point. The FOMO's there, but it's not extreme FOMO. The American consumer also is stabilized, so that's XLY versus XLP at these levels. And that's important for us to look at because, of course, if that starts weakening heavily, it shows us that we're near the end of the cycle. Now let's have a look at the US dollar, because the US dollar dropped off and actually broke underneath this level here. And to me, this is triggering the potential for the dollar to actually find some weakness. Now, somewhere around this 104.80, I'll be looking for the weakness to come back in and around where it is right now. So I'm paying a lot of attention to the US dollar chart, and it looks like there's a bit of currency action going on in this market. So certainly around here, I'm paying a lot of attention to the smallest timeframes, and we'll probably be able to update in the next 24 hours on dollar's choice, because it looks like it's about to make a choice on its next big move. What about copper? It's holding its own. Nice little bit of green for the last two sessions here, holding up against the wicks. That is a good sign. If we go down to the 2 hour here, you'll notice it managed to break above the 4.86, which is something we were looking at. And it's signaling that maybe this first daily 20 moving average might actually be holding copper up. So again, metals with the higher interest rate, possibilities, again, inflation, blah, blah, blah. This is starting to rise the copper, and it's making it look a little bit better. Gold also improved, but again, gold still being held down by the supply. It's not my type of trade. It's definitely a position, as we talked about, most traded level, 5% discount on gold, good headroom based on central bank purchasing, etc. So the future might be bright for gold, but right now, stuck at the supply. Silver, on the other hand, certainly still playing catch up, still in a squeeze in comparison to gold. And as you know, if you've been watching the channel for a while, silver-gold ratio we've been talking about a lot, and that's been, of course, strengthening recently. US oil, now this is where things get sneaky. So, of course, we initially had the bull zone here. We had to drop the position here because we had a feeling it would wipe the low, which it did. Then it came up, then it sold this zone, which again wasn't a bad trade, to the short side and didn't stick it. Now, this is right at that peak. It actually closed above the daily 20 moving average. And I tell you what, that's at 1, 2, 3. And this is the thing about Wyckoff trades. If that is a Wyckoff, which it certainly could be, it's pretty sneaky. And yeah, I think a lot will be unveiled in the next 24 hours. But oil, right at the precipice of where a seller's going to have to come in if they're going to. Otherwise, we're going to see a squeeze, and you would think that it gets back to 84 a barrel very quickly. This one here has been very sneaky, and it may seem like there's a lot of flip-flops because there's a lot of information changes in here. As we often say, patience, react, don't predict. In a positional base, this level here and around $72 a barrel would be my two positionals if I was to buy positionals without stop losses and etc., like a big bank would. But when it comes to trading, even if you nail a level, sometimes it can get sneaky. And I do think this is very sneaky here. So I'm interested to see how this plays out. And at this point, it's do or die for the bears because they really, really need to push this thing back down. Otherwise, it's going to start squeezing on the upside and create a momentum trade there. So we'll keep watching that one. Tesla still holding the base, 173, 172 seems to be where the buyers are. And that 180 seems to be a struggle zone for Tesla. So it's stuck between the calls and the puts at this stage. GameStop, on the other hand, although it did end up closing as a long leg doji on the daily, we managed to get it above the 23.78. Now, I think that's a fairly strong close for it. And I could see this starting to kind of create further squeeze on GameStop. Maybe it's anticipation of its earnings coming up. Who knows? I think that's around 7 days away. buy the rumor, sell the fact, I would say on that one. But certainly it's coming through, and that was a nice blitz out. And it just shows you, when the heat's on, you can get smoked. But when we saw about that $20 price range, that was certainly a sign of, an area where you could get back into it. And I think the next 24 hours, I guess I would say that there's a real potential for GameStop to try to get another couple of days of squeeze there. It's risky, it's gamble. I don't suggest it. Proceed with your own risks and caution. Another one that's squeezing up is Nvidia, breaking through 1100 over the last 24 hours and blitzing it, going all the way up to 1150 pretty much, and then finding a little bit of sellers. So every $50 increment is important here for Nvidia. It's certainly extended, there's no question about that, but I would never fight a trend like this. Do you remember these types of trends over here? When the squeeze goes and Nvidia goes, you've got to fight it. The only time that I thought it would go sideways was after this candle. And of course, it was proven correct. It did go sideways for a period there. So for now, it's bull, 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 and I don't see any reason at this stage to say Nvidia is terrifying, because it could squeeze all the way up to 1200, 1400, become the world's number one stock in only a matter of days. And I actually asked you over on X what you thought. Some people said 1 day till it becomes the biggest. Some people said 1 week. And at this stage, I guess if it keeps doing this, it'll be there within a week. Now let's move over to the major indices. So we've talked a lot about Chinese markets. We obviously talked a lot about this 20K level, and it stopped just before that and found a bit of selling. Now, am I concerned about it? Well, of course, I don't like that chart there. That looks pretty bad. But I think the reaction around 18,250 will be the most important, kind of upcoming thing, and then 17.6. I'm not concerned. I think when you run like this, you're going to always have pullbacks, and that's exactly what's happening in the Chinese market. And the same with any of those markets out there right now. You get these big runs, you're going to get a pullback. I think it's perfectly healthy and good thing to see. What about the Aussie market? Well, everyone's going to say, is that a head and shoulders? I would say, yeah, it looks like one. And it does look like the Aussie market's coming back down to the 75.50 kind of area. So at this stage, if there's anything to go off here with the Australian market, it's predicting that maybe the world indices are weakening across the board. So something, of course, to be watching on the charts. US 2K also weakening off that 2084 res and coming back down to that first bull level. Remember, if this gets taken, again, kind of looks like a head and shoulders, could be pushing a 2000 relatively soon. Something that I certainly would be paying attention to on the charts. NASDAQ 100, it's extended. It's being held up a lot by Nvidia and AI stocks, and that's a melt up. So would I attack this market? Not really. I think the S&P is a better attack, or the Russell, but yeah, at this stage you can see here it's a melt up, and it will follow in general the trend of the S&P. So something to be watching. And then it comes to the crypto market. 66 is where the buyers are from Bitcoin side, and this is just Chop City at the moment in the middle. So not much going on here. I do think that having an alert above 72,000 in the future, though, that could get really, really quick and super aggressive if that does happen. What I'd like to see Bitcoin do, which I've said for a while, is give a bit of coil here, break to the upside, get wild. That would be pretty sweet. And I think that's probably the thing that may do for now. Ethereum, on the other hand, this one here, I still think is extended after that good news story of the ETFs. So I could see it pulling back and then doing something like this. Certainly one to be watching if you're in it. No reason to be scared of it yet. It's still making a series of higher highs and higher lows. But yeah, I think you could be cautious a little bit if you wish to get into new positions. So let's now move over to the news. And we know there are some news stories coming out. Core PCE, I guess, is the big one on Friday. And we just saw the CPI for Australia, which showed heat again. So again, no cool down in inflation through many countries throughout the world. Why is that? Well, central bankers don't really want to cool it off. They're not doing the right things to cool it off. As always, guys, make sure to subscribe if you enjoyed today's video. Check us out on some of the socials. And if you want to find out more about the sponsor of today's video and some of the cool tools they have, and they're always giving more, then you can do so. Links in the description down below. Thanks so much, everyone. We'll see you in the next one. Bye for now.